Well, good evening, everyone. Welcome to the fourth virtual StockSlam this year already. It is an absolute pleasure to be back here again as your host tonight after our last event in May. Once again, we have an excellent lineup of speakers with and companies they're pitching for the very first time. In fact, we're even throwing in a bonus presentation tonight to ensure you get value for money. It's really very exciting for us because we want to encourage investors to get involved with the slam, and having new people come along and present just makes it very worthwhile. Now, one thing I should say is that Alan McBride has kindly updated me with the performance of the picks from the last 3 slams. And so far, the total portfolio of 30 holdings is up 8.4%, which isn't bad considering how the market has fared recently. As you might expect, there's a wide spread in performance, with Halfords now taking the top spot at up 52%, and Tech Capital closely follows behind at 48% up. Renault, unfortunately, has gone backwards, dropping from a gain of 75% as it was last month, down to 35%. But that's still highly creditable. At the other end of the pitch, we have Caledonia Mining, which has drifted down to minus 19% since February, with Tharisa keeping it company at minus 17%. I guess that tells us that mining companies are out of favour at the moment, while turnarounds are definitely attractive with investors. A final interesting point is that the most recently pitched companies from May have a much tighter spread of performance, going from 12.8% down to minus 9.5%, which shows you really need to give shares a chance to perform in order for them to kind of work their magic in your portfolio. So for those new to the slam, I'll quickly explain how it all works. Each presenter is given 3 minutes to pitch their idea, which tends to pass very quickly. Then we allow another 3 minutes for questions from the audience, and Tamsin will explain how this works in a moment. After that, I'll introduce the next speaker, and we'll start the whole process again. All in all, the slam should be done and dusted in a little over an hour, although it could be slightly longer tonight because, of course, we have an extra presenter. One other thing I'd like to mention is that everyone presenting here tonight is doing so in a personal capacity, just in their own right. This means none of us are giving share tips or advice. These are just investing ideas that we're happy to share with a wider audience. And to avoid any doubt, it's best to assume that presenters hold the shares they're pitching and are talking their own book. That's certainly true in my case. And finally, I'd just like to thank PIWORLD and Stockopedia for their assistance as ever, because none of this would be possible without them. Okay, so tonight I'm going to be talking about GAMA Communications. So the ticker for GAMA is GAMA. Now, GAMA Communications listed at the back end of 2014 at an offer price of 187 pence. In the 6.5 years since then, the shares have 10 bagged as earnings have grown by more than 20% every single year, and the CAGR is a remarkable 27.6%. And the earnings multiple itself has doubled from a range of roughly 15 to 20 to 30 to 35. Clearly, investors are warm to the company, and looking at the stock report, it's easy to see why. From a quality perspective, and if you can just scroll down a bit there, Tamsin, the return on capital is a solid 25%. The operating margin has been improving for the last 5 years. The share count is essentially unchanged, and cash in the bank has sat at 25 to 35 million pounds, despite a number of acquisitions in recent years. These are great numbers, I'm sure you'll agree. However, this performance has not been without chance. When GAMA listed, it was a provider of B2B communication services, which meant it provided the plumbing around fixed and mobile phone lines, along with broadband and other data services. This is the bottom in the communication stack. And make no mistake, there is a real benefit for customers to outsource this critical part of the infrastructure. However, wholesale broadband and telephony is a competitive low-margin market. Fortunately, the GAMA board realized that they could move up the value chain by leveraging their call handling products and by providing a reliable, high-quality service. And as a result, GAMA has turned itself into a provider of unified communication and cloud contact center services for enterprise, SME, and micro companies. In simple terms, it provides a full-stack collaboration platform that has significant functionality as the customer size moves from 10 to 10,000 employees. Importantly, this platform collects a wealth of data, which GAMA then makes available to other business applications via a wide array of integrations. And one of these connections, as you would hope, is with Microsoft Teams, which proved rather useful during the pandemic as the telecom and ICT worlds converged far more quickly than anticipated. So what about the future? Well, GAMA is riding a long-term growth market as adoption of cloud services increases. This would in itself generate organic growth as the company addresses all size segments, while bolt-on acquisitions in Europe are adding inorganic growth in less mature markets. And this is significant to Spain, Netherlands, and Germany, providing opportunity 3 times the size of the UK market. And GAMA, usefully, is able to finance these purchases out of internally generated cash flow, hence no debt. Looking at the analyst forecasts, these indicate that earnings will rise 15% this year before moderating to 12% growth in 2022 and 2023. However, what we've got to bear in mind is that GAMA tends to beat these forecasts as the year progresses, as happened with a trading update just back in May. For example, the 2021 forecast is already up 16.5% from a year ago, making it currently equal to the 2020 forecast back then, while the 2022 figure is up 18.3% over the year. It's this sort of forecast momentum that I look for in a share, and arguably, GAMA is not as expensive as it looks if it continues to exceed expectations. And now, I can take questions. Thank you.
Tremendous. Thanks, Damian. And we have one question so far. How much growth has been from acquisition, and what sort of businesses do they buy?
I don't have the split, I'm afraid, between organic and inorganic growth, but the businesses they acquire really fall into two buckets. On one hand, they are buying businesses, kind of bolt-on businesses in Europe, i.e. in Germany, in Spain, the Netherlands. And these are businesses that provide like cloud PBX solutions, cloud contact centers, that kind of thing. And what they're doing there is building a European business that they can then leverage their software into. So essentially they're buying, if you like, the company contacts to build a business of size, and then they're applying the same strategy they've applied in the UK to roll out in Europe. And the other type of business they buy are essentially bolt-on technology businesses. So recently they bought a software company which they'd worked with for a period of time, and this had both written software for GAMA, which they were very happy with, and they also had their own Circle Loop product, which is essentially a cut-down version of a cloud business for small companies. So they're building acquisitions in kind of two ways, but they're all complementary to the main business.
Thank you. And there have been multiple director share sales. Is that an issue?
Well, it's funny you should say that, because I was looking at the director share sales, and the history really of GAMA is that it's not so much that had founders, but there was the guy who really started used to work in a company called Man Investments. He was a commodity trader, so he had a lot of money behind him, and what he did was invest it into buying the kind of the telecom bits of a failed company and then building GAMA from there. And so that meant he had a lot of shares, and his sons also had a lot of shares because they were part of the investment business. And funnily enough, one of his sons has been consistently selling shares all the way from £4 up to £20. So just year on year, selling down his holding. And I think that the recent sales by him make no difference, because this is just a consistent strategy. Whereas the father, although sadly he died a couple of years ago, his holding actually remains intact in the company and hasn't been sold down. So I don't think that these direct sales make any difference. And I think it's interesting that the strategy, if you like, employed by both father and son are quite different.
Thank you. And who are GAMA's competitors, and does it have a moat, in your opinion?
Well, that's a very good question. I mean, they pride themselves on quality of service, and they pride themselves on delivering software that makes tangible kind of sense benefits for the customer. Now, you might well say that all people do that. I mean, it's a sensible business strategy. So what you might say is that, well, Microsoft could, in a sense, be a competitor, because Microsoft Teams is essentially like at the top of the tech stack. They provide the business applications, and they also provide kind of contact software and call management software themselves. What they don't do is provide the bottom of the pile, which is the communication telephony side of things. And it's there that GAMA kind of can be bolted on to Microsoft Teams. But they're not really direct competitors because they don't provide the whole stack, whereas GAMA provides the whole stack. What the other competitors are, I need to look and tell you.
Thank you. And very quickly, what's your share price target?
I don't have one. I mean, if they can keep doing 20 to 30% earnings growth per year, I don't see a particular reason to set an upper limit on that, as long as they just keep growing and following a strategy that has worked for them for the last 15 to 20 years.
Thank you very much, Damian. We've got lots more questions, but we've run out of time. Back to you.
Okay, so now up next we have John McFarlane, and he's going to talk about Redde Northgate. Over to you, John.
Hi guys, and thanks for the early slot. I'm going to whiz through my notes here so I can get to the pub for the end of the polling game. Redde Northgate has had a stock rank of 90 or so for much of 2021. The company came to be in early 2020 when two core businesses merged. Redde, a vehicle services business, and Northgate, a commercial, mainly white van vehicle hire business. The latter makes up about 75% of the merged business. When the businesses merged, directors bought around £250,000 worth of stock and seem to own about 1% of the company. There's half a dozen respected funds also own around 5% each. An ahead of expectations update last month confirmed integration was going well, with targeted synergies of around £15 million pretty much in place and well within budget. This integration and these synergies should help push last year's 4% margins closer to the historic 10% levels. There is a lot of net debt here, about £500 million, which is about half the current market cap. But this is well backed by assets, which include the 100,000 plus vehicles in the fleet. And I think a reflection of this is the net debt is under control, the yield of 4% plus, which is 2 times covered. EPS is set to grow 17% plus in each of the next couple of years, from 29p this year to 34p in 2022. And although not shown here on Stockopedia, I don't think, Zeus, the house broker, forecast EPS of 43p in 2023. And they recently indicated fair value of 447p with upgrades likely. I started buying in September last year around 200 pence, and my average price is 295. And although the share price is 400p, if it was not a top 10 holding, I'd still be adding. And here's why. The synergies, white van demand and more vehicles on the road again, hopefully means that Redde Northgate can grow the EPS 17% plus in each of the next couple of years, based on conservative revenue growth and margin improvement back to previous levels. EPS of 43p in 2023 gives us single-digit P at today's price. The industry median is 18.5. If I apply a conservative P of 15 to that Zeus forecast, I get a 3-year price target of 645p. That's 60% upside without the 4% yield or Zeus's likely upgrades. Chart-wise, 400p has proven to be resistant in the past 6 weeks. Full year results are due on the 7th of July, and I'm hopeful they read well and that 400p breakout and Zeus upgrades follow. And that's it. Any questions? Keep them simple. I'm going to the pub soon.
John, thanks very much indeed. What's led to the margin erosion from 2017 to 2020?
No, I think that's all based on the historic business of just Northgate on its own.
Okay. And are you concerned about the earnings manipulation risk flag?
No, I've no idea. All I was really focused on here was that EPS growth.
Okay.
I just thought it looked pretty outstanding for a company that's looking at this on the single-digit PE.
Okay.
Forecasted 17% on a 4% yield. So I haven't noticed the earnings manipulation risk. Sorry.
And do you have a view on the future for Northgate's Spanish operation?
None at all. It looks like it's going to grow the same as the others. Spain is about, I think, a third of the business. And it looks, the last income statement I looked at, it looked like it's forecast to grow in line with the UK and Ireland.
Thank you. And the impact of electric vehicle sales surge. Can you say anything about that?
No, I just noticed in the recent update from them, though, that they are planning to buy more electric vehicles. I think around 20% or something was vehicle sales, and I think higher is 50%. Sales of vehicles is about 20%, and I think the other 30% is the vehicle services side, which is the old Redde business.
Tremendous. Thank you very much. Back to you, Damian.
Cool. Yeah, thank you, John. I enjoyed time in the pub. I recall Andy Buff talking about Redde Northgate a year ago when the shares were just 160p. He was incredibly bullish on the turnaround, and his enthusiasm has been rewarded. I didn't take any notice, but I guess you can't buy every good idea.
I think it was actually, Damian, I think it was actually Richard Leonard.
Was it? Because I thought,
yes.
Was that when they... Oh, interesting. Okay, well,
It was when they presented together. Anyway, I won't interrupt you.
Oh, that's fine. That was a great interview on PIWORLD. So next we have up David Thornton, who's a growth company investor newsletter I enjoy reading every month, and I'm looking forward to his presentation today. Over to you, David.
Well, thanks, Damian. And actually, Redde Northgate's a stock I've written about in GCI possibly as well. So I think it's a good story. I'm just going to talk about VP Group, which grey-haired people like me will remember as Vibro Plant before it changed its or abbreviated its name. It's a plant hire and an equipment rental company. It does have a small overseas business, but it's mainly UK oriented. I decided to do this stock last week, and coincidentally, Berenberg have just initiated coverage today. And the strapline is mispriced, high quality recovery story, which I think actually sums it up extremely well. So I'll deal with the recovery bit first. I spoke to management last week, and they say that activity in the equipment hire industry is rapidly recovering to pre-COVID levels, mainly driven by infrastructure. That's something they're very heavily exposed to, things like HS2, the rail industry, water, housing as well is particularly strong. General construction, a little bit quieter, but generally speaking, there's an increasing tailwind as the economy returns to normality and it recovers. Allied with the recovery bit, cost cutting, like a lot of companies last year, they accelerated some of the things that they'd been planning in terms of rationalising their distribution centres and so on. So they've cut about 7 or 8 million of costs out of the cost base. Some of that will come back, I'm sure, but that's another sort of plus when we're thinking about the company's recovery. Put that in context, prospectively, they're going to be doing about 50 million of profit. Moving on to the quality bit, they've got an excellent long-term record of disciplined growth. They've achieved pretty much a 15% return on capital employed in the context of being able to continue to grow the actual business, the actual fleet that they're renting out. They did the acquisition of Brandon Hire a couple of years ago, which has made them the biggest tool hire company in the country. They're also an inflation hedge, which I quite like. They basically fund their hire fleet with debt. They have residual prices when they come to sell a fleet at the end of its life, and they can increase hire prices if there's an inflationary environment. So I quite like that as a nice hedge. Moving on to the final bit on the quality bit, they're 50% owned by the chairman, which is a good thing. I like sort of family-owned or significant shareholder businesses. On the mispriced front, they're on about 12 times earnings this year. On Berenberg's forecast, that falls to 10 times to March 23. They regard that as a highly conservative forecast, and actually they say it could be nearer 9 times earnings, 3.5% yield as well. So for a 15% return on capital employed business, growing, basically a very good long-term track record, I think that's excellent value.
Thank you, David. Why has the cash conversion been so poor historically?
I don't think cash conversion has been poor historically. They are debt funded. You basically, the 58% of the hire fleet is funded with debt, and as you grow, you continue to reinvest in the hire fleet. It's a profitable business, but it uses debt to grow. So I'm not quite sure I agree with that statement.
And is that the reason they also have a bad Z score on Stockopedia?
Very, very probably. I think a lot of these mechanistic things don't like high debt businesses. I think the important things to note here is that it always books a profit on disposal of assets. So it's investing, and depreciating conservatively. That's the key. It's depreciating conservatively. So and it's an asset-backed business with liquid fixed assets that it, as I say, that it disposes of on an ongoing basis. So the sort of those moving levers of cash and debt, I think, I feel very comfortable about.
Thank you. And how would you compare VP against Ashtead?
Well, I guess VP is probably on about, a third of the rating that Ashtead is on, maybe even less. I think Ashtead shows you, how, well managed hire business can be phenomenally successful. VP has grown obviously at a much slower pace. It's in the UK rather than the big US market, which Ashtead is in. But it's a high quality business. It's not something I think we're going to triple our money in overnight, but certainly to my eyes looks 30-40% undervalued, and it's a sort of business as well which would be of interest to private equity owners, given your ability to use leverage. And
over what sort of period would you see that increase in valuation?
I could see the stock up 30-40% on an 18-month view. It's a re-rating play with upgrades hopefully coming through, and I think you just have to be patient with these businesses at times. But at some point over the next 18 months, I'll be very surprised if it didn't re-rate to reflect the the value and the recovery.
And it seems a very competitive sector. What's their competitive advantage?
Well, as I mentioned, they acquired Brandon Hire a couple of years ago, which they've merged with their own hire business. So they're the UK's leading tool hire company. A lot of their other sort of segments they're in, they have long-term contracted relationships with their customers, and they say they've just got it's just basically those long-term relationships and so on. It's you're buying kit and renting it out, so it's not exactly software, but it's leveraging that network and that experience and those relationships.
Tremendous. Thanks very much, David. We've got lots more questions, but we've run out of time. Damian, back to you.
Cool. Thank you, David. I must admit, with the construction market going bananas, I can see the logic in buying a picks and shovels supplier such as VP. However, as somebody said in one of the questions, I'd probably be happy with Ashtead as it was pitched here in April, despite its violent re-rating the last year. I think that's a quality company. So next up, we have Andrew Robinson, also known as Castle Tiger. He's going to be talking about Tandem. Off you go, Andrew.
Good evening, everybody. Hi, Damian. Tandem PLC, Epic TND, is a group of companies with a headquarters based in Birmingham. It designs, develops and distributes sports and leisure equipment and has some well-known brands in the business. Ben Sayers in golf, Pot Black in snooker, Kickmaster, and a whole range of licenses such as Peppa Pig, Batman, Lion King and Toy Story. The business has a turnover of approximately £40 million a year. While this figure has been pretty flat over the last 5 years, profits have grown from 700,000 to 3.5 million. The business is split into several sections. The FOB business, which is direct container shipments from production facilities in the Far East to customers' own sites. That could be people like Halfords or major supermarkets. Importing and then distributing the goods from our own 80,000 square foot site in Birmingham to IBDs and to smaller businesses. And in Northamptonshire, it's a recently developed Expressco business, which is an online DTC business, and it's fast growing and currently represents about 25% of the total sales of the business. There are some headwinds within the business. At the moment, there's a defined pension deficit costing 330,000 a year, and additional payments if the dividend amount exceeds this total cost. However, the biggest short-term issue, and this is the bit where people are getting a little bit tied up, and running a business and understanding what's going on in the world at the moment, I'm fully aware of this, and we're having the same problems. That is actually getting the physical containers to ship the goods from China in particularly and the Far East. The world containers are all in the wrong place. That's the physical containers. They're all in the wrong place, and freight costs have increased, and there are some serious delays. I expect tomorrow's trading statement from Tandem to mention this. I believe that June may have been slow because orders are probably, the goods are still sitting in China. Now, these orders are not lost, but they've just been delayed getting to the UK. The main changes within the business was that the board they had a new CEO and chairman. They've got 10% of the shares between them, so there's some skin in the game. They immediately engage with shareholders, and the relationship is very good. There are no brokers forecast to aim for, but this offers us small shareholders the opportunity of buying in much cheaper and on a very low rating, which is currently under 9. The company is valued at just 30 million with a strong balance sheet, no debt, and that's holding between 3 and 6 million in cash. The business made over 3 million last year. I can see it making close to 5 million this year, give an EPS of between 80p and £1, and as much as £10 million by the end of 2020. Factors that will bring that change are a construction of a new warehouse on their existing site in Birmingham. That's going to cost £6.5 million, of which they're going to fund with cash, and completion is due in July 2022. Expressco, the online business, achieves big margins, but is only turning over 10 million a year. In a highly fragmented market with low-hanging fruit, I think that this company can grow sales to in excess of 50 million very quickly. That's the exciting part. That's the bit I think the market's missed.
Thank you very much, Andrew. And do you think the increased cost of distribution will affect them?
I think they'll be able to pass it on. We've got the same problems in the goods that we're importing. People are wanting bicycles. People are wanting products. Everyone's trapped within the UK and have been for nearly 2 years. There is inflation, particularly in construction and importing goods. And I think if you want these things, then they'll be able to pass those increases on.
Thank you. And don't you think they've had their day in the sun already with bike sales last year, and it might be flatter this year?
Certainly not. I think this year will be much, much better. Their trading statement, the two trading statements this year, one said that at the beginning of the year they were 90% up. The last trading statement said they were 23% up. Huge amount of demand that will run right through at least until the middle of 2022. But it's the Expressco. This is the online business that's in there for free, that's growing very, very rapidly, between 25 and 50% a year in a highly fragmented market. And if I was running the business, I would amalgamate that division in Northampton to the new site in Birmingham, clip out £1 million worth of costs with that, closing the other site and moving it there. And that would drop straight onto the bottom line. Thank
you. And why was there no dividend for 2021 and no broker analyst forecasts?
I thought there was a dividend. The dividend this current year to be paid is about is just under 9p, which is irrelevant with the share price at £6. There are no brokers forecasts. I don't think the company are prepared to pay for that kind of information. But I think that gives us an opportunity, because the share price, having moved very quickly from £1 through to £7, between £6 and £7, has only just started its journey, because the valuation, this is just missed. It's too small. It's not got any institutional investors, because it's a tiny, possibly slightly liquid company, and building a good position does take a long time. But it's done very well for the holders over the last 2 years.
And that's time. We've got lots more questions, but I'm afraid we've got no more time. So thank you very much, Andrew, and back to you, Damian.
Yep, thank you, Andrew. I also hold Tandem, and it is pleasing to see the progress made by new management after we look at the share price, a decade treading water. Hopefully they'll sort out their supply issues soon, because I fancy buying an e-bike. So next up, we have Donald Pond, who's going to talk about Phoenix Copper. Away you go, Donald.
Okay, a bit of a different one, this one. So investing is all about risk versus reward. And I think Phoenix Copper, with the ticker PXC, has about the best risk-free reward out there. It's an emerging metals producer in Idaho, in the US, which is ranked the #1 mining jurisdiction in the world. So as well as having a fantastically strong rule of law, the total royalty and tax rate on any profits the company makes is going to be less than 10%. Which you can compare that to many other companies that will be paying over 50% in some countries. So they are focusing on green metals. So that's copper, silver, cobalt, lead, zinc, and they've also got gold and environmentally friendly processors. So let's talk about the finances. The market cap is £50 million. And after a big placing earlier this year, the company currently has 15 million in cash, so an enterprise value of 35 million, which is going to be enough equity to get them into production. They will need some debt, but it will be manageable, so there won't be any further share issuances, which is key. There are multiple projects, but a clear strategy, and that is to become profitable as soon as possible and prove up all the other reserves they have from a position of independence and strength. The main site is Empire, which was a copper mine until the 1940s, producing grades of 7 to 8%, very high grades. The CEO's family actually worked back there in the mine. So although only 1% of the Empire project has been explored, there's had over 450 holes drilled, and the company knows that 1% is enough to make a profitable miner. So their priority is to get an open pit going, targeting copper production late 2022. It's going to cost about 52 million and have an annual projected free cash flow of around 50 million a year. So it will pay for itself in a year, even less than that if the price of copper stays at current levels. The measured and indicated resource there is $1.4 billion, so that it really is just the tip of the iceberg. As well as copper, there's shallow gold there at grades of over 9 grams a ton, and that can be processed from years 4 to 10 with a bit more money. Beneath the open pit, though, are deep sulfides. There's a big porphyry system, and it could be of global importance. That is the big prize. So whilst making profit from the open pit, the sulfides are being confirmed. There are other things around there. There's Red Star, which is a silver-lead high-grade vein project. That's being subject of an electromagnetic survey at the moment. They've also got Navarre Creek, which is a Carlin-style gold deposit, which means big, low grades, but very profitable, similar to the huge Nevada gold mines. But it's all about the focus here, taking it in bite-sized chunks, getting into profitability, aiming for dividends in 2023, and proving up the big reserves. There's good research from at least 3 brokers, including Hardman. You can get their paper easily. And the board are very approachable. I'll just finish off by saying that the location's the best in the world, metals are in demand, the board are very experienced, the company is cashed up and is aiming for profitability by 2023. So it looks to me like the risk reward is excellent.
Thank you very much indeed. Why is there such a high proportion of directors and institutional selling?
No, there isn't. There's the
That's
simple
funny
answer.
because I've had that question 3 times here. So I don't know where that's come from.
No, there isn't. I mean, there was a large placing about 2 or 3 months ago, and that obviously scuppers the proportions of things. But the directors haven't been selling at all. They've got about 6% of the company, and there was the announcement of, in terms of institutional holders, there aren't many who have disclosed, but the most recent ones, Canaccord, have announced, I think, about a 6% position. And I'm told that that was Giles Hargreaves personally who was pitched and made that decision. So, you know, you don't get a bigger endorsement than that.
Thank you. And why was production stopped at Empire and left for so long if it's such a good prospect?
Well, the simple answer is there's 2 prospects there. You've got oxides on the top and sulfides down below. And the technology in the 1940s didn't really exist to make the most of the oxides. So the sulfides were getting deeper and deeper, and people went away from the war, and they just didn't really go back to it, is the simple answer. But the grades that they were pulling out there were 7 to 8%, I mean, which are absolutely huge grades. You know, yesterday I was presenting for ShareSoc, another company in North America, and they're putting out grades of 0.25% copper and making good profits. So if that deep sulfides, if it's anywhere near 7 or 8%, and I think the company are hoping it's anything above 1% would be huge, then you've got something that is probably of global importance. I mean, they will say off the record that they think it could be one of the top 20 copper mines in the world, and they're aiming for $1 billion company, which they built before at Oxus, only to have it stolen from them by the Uzbek government. So they decided to try and find a resource somewhere else that's a bit more stable than Uzbekistan.
Can you talk a little bit about the risks, which seem quite considerable?
Well, it's funny you say they're considerable. I mean, I asked the guy in operations, Ryan, who is he's the mining expert. He's the guy on the ground there. He's from Idaho, and he's the one whose family all worked in the mine. I said, you know, what concerns you here? And he said, look, we know from what we've drilled so far, over 450 holes we've drilled, we know we have enough to make a profitable copper mine. The only thing that can go wrong here is the price of copper itself. If the price of copper crashes, then they don't make money. But if it's anything above 170, 180 a pound is in terms of dollars, $1.80 a pound is their cost of producing copper. He said anything above 350 a pound, and he said I'm turning somersaults, and it's currently well over $4 a pound. So that's the risk. I mean, it's important to say this is not an exploratory play. This isn't someone getting a load of money and saying we're going to prove up a huge resource or we're going to look in the jungle. They know pretty much what they've got. It's just a question of how much they've got.
Tremendous. We do have more questions, but we've run out of time. Thank you very much indeed. And Damian, back to you.
Cool. Thank you, Donald. I mean, it's funny how everyone was talking about the commodities super cycle this year, and yet everyone seems to have gone cold on the resource sector recently. But since metal demand is set to remain high, you could be looking at an excellent buying opportunity right now, even if Phoenix doesn't float your boat. Anyway, if you didn't like Phoenix, next up we have another mining company, courtesy of Mark Bentley's Endeavour Mining. Over to you, Mark.
Good evening, everyone. Endeavour is probably the largest UK listed stock that you may never have heard of, with a 4 billion sterling market cap. Previously, it was only listed in Toronto, but has now re-domiciled as a UK PLC and is premium listed on the London Stock Exchange, as well as retaining its TSX listing. It's the largest gold miner with a premium listing on the LSE. In overview, it's a West African pure-play gold miner, the largest in the region. It has 7 mines in 3 countries, which diversifies the risk. It's expected to produce approximately 1.5 million ounces per annum this year and going forwards. It's one of the lowest cost top 10 gold miners, with an all-in sustaining cost of $850 to $900 an ounce. It has a superb execution track record. I've owned it since 2012. It's consistently met production and cost guidance. It's built 4 mines, all on time, on budget, and operating in line with production and cost expectations. It's also achieved good delivery on its exploration targets. The company has a strong track record of good capital discipline. It's progressively improved the quality of its mine portfolio by M&A and disposing of lower quality mines. All but one of its mines has low cost and long life. Moving on to the numbers, the company is highly cash generative. In 2020, it started with $528 million of net debt and finished with $75 million of net cash, and declared its first dividend totaling $60 million. Ahead of its London listing, it announced a 3-year minimum dividend program, paying out 50 cents this year, 60 cents next year, and 70 cents in 2023, subject to the gold price remaining above $1,500 an ounce. It's also operating a share buyback program. Edison gives it a discounted cash flow valuation of £25 per share versus a current share price around £17. Its price to operating cash flow is 4 to 5 times. Only Harmony Gold amongst the senior producers is trading on a lower price to cash flow. Has the highest cash flow yield of all top 10 miners at 12%, and a ROCE of around 20%. There are a number of short-term catalysts. In particular, it will enter the FTSE 250 in September, possibly the FTSE 100 if the share price reaches £22. And there are a number of other significant announcements expected that I don't have time to cover today.
Tremendous, Mark. Well, you've completely stunned the room because there are no questions at the moment. But what's your price target over what sort of period?
Okay. I was aiming, my holding is on the Canadian exchange, so my price target was $40 Canadian. Can't remember what that translates to exactly off the top of my head, something like £23 thereabouts. And we're getting well paid while we wait. That's very much based on it coming into various tracker funds and other type of funds that it's now accessible to, which it wasn't previously. And the fact that it's significantly undervalued compared to its peers. So that would bring it more into line with peer group valuations.
Why has the working capital increased recently?
Okay, over the history of the company, the working capital fluctuates a lot. It depends on the precise timing. It varies from quarter to quarter, depending on the precise timing of gold sales. VAT receipts is another issue that affects the cash flow significantly, that they go up and down. So the last quarter, the working capital increased quite a bit, but it's not likely to happen again. And in the final quarter of last year, it reduced quite a bit. So it tends to jump around quite a lot, the working capital.
And why has the share count increased so much?
Because in the last year, it conducted two major acquisitions for shares. The first of Semafo Gold and the second of Teranga Gold, which roughly doubled the size of the company.
Thank you. And what are the country-specific risks? Somebody mentions here specifically West Africa.
Probably the largest risk is terrorism. I mentioned that it took over Semafo. One reason it was able to do that cheaply was because that company had suffered a terrorist attack and they had to shut down their main mine for a period. But Endeavour, first of all, has one of their directors is specifically in charge of security. They have a good relationship with the Burkina Faso government. That mine was in Burkina Faso, and they've put a number of security measures in place to reduce those risks significantly. The governments in the region, there's always a certain amount of risk there, which is why the diversification into 3 countries is helpful. But the mining regimes have been relatively stable, no big jumping around in taxes. The governments have stakes in all the operating companies, so there's alignment there, and they've got a reasonable royalty and tax take, but not too much from shareholders' point of view, sort of 25 to 30% range, which is fully taken into account in the all-in sustaining cost. So with gold prices around $1,800, you're making $900 an ounce after tax on each ounce you pull out of the ground. So as you can see, that's why it generates huge amounts of cash.
Tremendous, Mark. Thanks very much. We've got lots of other questions, but we do not have time. Damian, back to you.
Cool. Thanks, Mark. I mean, the problem for me is that gold seems to be the dog that didn't bark, despite ongoing concerns about inflation. Perhaps one day the gold price will react, but with QE well into its second decade, I have no idea when this day will come. So next up, I would like to welcome Dexter Burt, who runs CipherSense Research, which often publishes bare notes that make me feel uncomfortable, but I enjoy reading. So over to you, Dexter, who's going to talk about Supreme.
Thank you very much, Damian. So firstly, who is Supreme? Supreme went public in February this year with a valuation of 156 million and an expanded to higher margin product categories and captured a greater share of profits through vertical integration. So I just want to cover a couple of points of why you should invest in Supreme or consider them as an investment, because they haven't got a huge track record as they listed this year. So you're buying a highly entrepreneurial and innovative business that's grown revenue and EBITDA at a 10-year CAGR of 15% and 30% respectively. They've built the UK's largest e-liquid producer by volume and a sizable sports nutrition business from scratch. This ability to identify attractive product categories, take risks and bring unique products to the market gives Supreme a competitive advantage against other commodities. So they also have a hugely defensible position in durable product categories. Both the battery and lighting categories are underpinned by licensing agreements with major manufacturers that limits capacity and restricts new entrants. With the likes of B&M and Home Bargains, who are continuing large-scale store rollouts and expansion, Supreme is well positioned to take advantage in this natural rise in demand. On top of that, Supreme have strong regulatory support for the product categories they represent. Public Health England is encouraging the use of e-cigarettes to achieve the UK government's ambition of being smoke-free by 2030, which is a huge boost for their brand 8A vape. The lighting category also benefits from the fact that the banning of halogen light bulbs comes into effect in September. They're one of the major retailers in the UK, or they service some of the major retailers in the UK in this category. Now, Supreme generates admirable returns on capital. So over the last 13 years, they've delivered a return on invested capital of around 35% on average. And if you look on an incremental basis over the last 5 years, that's more like 70%. So it's all very well and good having this high return on capital, but is there runway for growth? And there absolutely is for Supreme. There's a hugely fragmented market in the supplements market. And if you look at the acquisitions they've delivered, they've acquired Protein Dynamics, Go Nutrition, and LED Hut, all out of administration to supplement their organic business. And their recent acquisition of Vendec is another example of a well-priced deal, closing out at 3 times EBITDA, which there's a great merger multiple arbitrage case there. They can continue to do these deals at lower multiples and then re-rate it in line with their multiple today. This should be a strong pathway to growth. On top of that, there's also the opportunity to continue the vertical integration. So unlike other distributors on the market, if you look at UPGS, Supreme have a far superior direct-to-consumer channel. And if you look on Trustpilot, for example, they're the most reviewed and the highest ranked online vape store of any vaping manufacturer, which shows how good they are at building this organic capability. And that's all I've got. Thanks very much.
Thank you very much. The graph is fairly flat. What do you think are going to be the catalysts to change that?
I mean, they only listed in February, and I think if you look at the shareholder register, they've got some very experienced investors who have backed similar stories to this before. So if you look at Slater holding this, he invested in Future back when they come to market. I wouldn't really look at it on a short-term view. I think people are skeptical because of the fact it's because of the vaping business. There's a lot of noise in the US about whether this is a safe way to help smokers quit, and that's possibly why people are a bit apprehensive. And couple that with the fact that they're selling batteries, which is a category that is in natural decline. People are probably a bit apprehensive, but there's a lot more to this business than what meets the eye.
Thank you. And why did they abort an IPO about a year ago?
I think, it's an interesting point. They cited reasons about the market wasn't rating it at the right valuation, and I think their earnings are a bit lumpy. If you look back, some of their cash conversion was pretty poor, and maybe it was proof of concept because of the fact that their vaping business wasn't that mature at that point. But now they've proven that they can roll this out and actually manufacture on a big scale. They only bought manufacturing in-house in 2017, I think. So to then go live or to list a year after that might have been a bit premature. They've proven now that they've actually got capacity to service the whole of the UK in e-liquid. And I think that capacity is servicing a very small part of the market as well, because they target the value range. So I think I'm not entirely confident in why they aborted it, but I think the reasons for coming public this time around are sound.
Thank you. And are you concerned that 2 customers account for 36% of revenue, or they did last year?
When you look at that, it's important to remember that those customers obviously aggregating consumer spending of thousands of individual customers underneath them. When you look at other companies like Bloomsbury, for example, who sell an awful lot of stock to Waterstones or Amazon, naturally these are just the largest outlets to reach those customers, and actually those retailers need Supreme because Supreme have the proprietary products and the IP that those customers want.
Thank you. And what steps have been taken to reduce their high level of debt?
So that debt was introduced just before the IPO. So they had a change in capital structure. It looked like the founder wanted to take cash out of the business before listing, which, given the cash conversion and the supposed debt coverage, I'm not particularly concerned about. It's got an interest coverage of about 14 times, and net debt to EBITDA is probably around, I think it's under 2, so it's like 1.5 times. So at that level, given that it should continue to generate cash, I wouldn't be concerned about it at the moment.
Thank you, Dexter. We do have many more questions, but we've run out of time. Thank you very much indeed. Damian, back to you.
Thank you very much, Dexter. Another new listing, which looks great to just say on historical forecast numbers. I am a little wary of such situations after UB Global Sourcing stumbled badly within 6 months of its IPO, causing the share price to crater 95%, but hopefully Supreme will be more successful. And now I'd like to welcome Twenties trader, who writes some excellent research notes and available through Patreon. You may have seen him on Twitter, and he's going to be talking about Frontier developments. Over to you.
Thank you, Damian. Good evening, everyone. So the company that I'd like to talk about today is Frontier Developments, a video games producer and developer. So some background on Frontier. The company's been around since the 1990s. It Listed in 2013, but it's still owned 30% by CEO David Braben. Frontier pivoted from a work-hire games development business, like other listed companies, Sumo and Keyword Studios, but it's now a vertically integrated developer and publisher. It was born out of the Elite franchise, and now a majority of the business comes from mogul simulation games such as Planet Coaster, Planet Zoo, and Jurassic World, to which Frontier own the IP for. In the case of Jurassic World, their largest franchise, they licensed the branding for this from Universal. To go over the current situation, the business has provided its full year 2021 numbers on June the 11th of 91 million in 2021, and the midpoint for guidance for 2022 is 140 million, followed by 170 million in 2023. If these estimates are hit, it will mean the business will be growing top line 54% in 2022 and 20% in 2023. We've had delays to one title, an F1 game, and some bad reviews for the Elite franchise in a latest update, but we've also had the signing of a Warhammer Age of Sigmar title licensed from Games Workshop, which is a real testament to the quality of the business. The stock's declined roughly 30% from its peak, which was roughly in line with the sector ETF, Vanet Gaming, but it's diverged about 10% from its latest update on the 11th. The largest institutional shareholder, Swedbank, has been acquiring at these levels, and it's also important to note that there's been quite considerable level of consolidation in the industry, with Codemasters having a bidding war last year and big tech looking to get involved in the scene, with Microsoft buying a games developer recently and Amazon buying MGM. You can see that content is really on the menu. I think it's a good business because of the 30% holding by CEO David Braben. The company owns its own IP, and controlling the development and publishing means that margins are high. So gross margins are roughly 70% and operating margins 22%. 60% of the revenues are typically derived from the back catalogue, and pre-order volume for new content gives good guidance that the 140 million would once again be hit. It's got good growth, and it's also opening up a new publishing house called Frontier Foundry, which should accelerate the top line. On the balance sheet, it's got 34 million of net cash, so we're looking pretty solid in that terms. Looking at valuation, it's on a 33 times forward PE, which is punchy, but nothing untowards when we look at the wider sector.
Tremendous. Thank you very much indeed. The revenue seems fairly lumpy. Is this something you just have to accept with Frontier Developments? It's probably more lumpy than other games companies like Team 17 and Sumo.
Yes, no, that's a good question. I think, for instance, on Sumo, it's a work for hire, sort of developer, so you can have contract-based revenues coming in over time. So it is slightly lumpier due to the release of certain titles. And in the past, you've seen a kind of step-based revenue growth where it goes up in sort of significant increments. But I think if you look at the pipeline going forward, especially looking at 2022 and 2023, you've got a key release of Warhammer in 2022, which should drive good revenues, and a release in F1, an F1 game in 2023, which should sort of drive further revenues. And the new publishing unit, Frontier Foundry, should kind of give scale. So I think as the business grows scale and kind of moves further away from its roots as a developer and more into a publishing house, you'll see that kind of revenue growth lumpiness fade out a bit.
Thank you. And it seems to have a lot of revenue but struggles to turn it into profits. Why is that?
I'd probably say on the profits terms, I'd probably argue against that, saying that if you look at the operating margins over the last 2 years, you've got an operating margin of 22% and you've got a gross margin of 70%. So if you compare that to a development house such as Sumo Group that has gross margins of 40% and operating margins of 10%, you're looking at quite a good turn into operating profits there as well, compared to some of the other developers.
Thank you. And don't you feel that the UK video gaming sector is trading at a premium to the likes of Activision, Blizzard, Take-Two, Tencent, EA, and others like that?
Yeah, it absolutely is, and I think there's a reason for that being, the size of the businesses in the UK. They're fantastic quality businesses, but they're a lot smaller, so they're premium targets for these businesses such as Tencent. If you look on the shareholder register, Tencent actually own a holding in Frontier Developments, like they do Sumo and probably everyone else. So there's a lot of consolidation. People want content, and for these big companies, it's easier to just buy your kind of content and IP rather than developing it yourself. If someone's got a good track record and execution with a fan base in the industry, it's so much easier to buy that in than to develop it yourself. So I think the size works for bolt-on acquisitions for the big players here.
Thank you. We do have more questions, but we've run out of time. Thanks very much indeed. And Damian, back to you.
Cool. Thanks, 20s Trader. I do have a soft spot for the computer game sector, and I do hold both Team17 and Sumo to give me some exposure to the long-term growth here. But I also like the fact that Frontier is working with Games Workshop, one of my holdings, to create a number of Warhammer games. Could be great for both companies. So next up, we have Charles Ford, who's going to talk about Novacyt. Over to you, Charles.
Hello, Damian. I've chosen a very controversial share at the moment, namely Novacyt, which Tamsin described as Marmite. Clearly, there's been a lot of activity this week with the full year 2020 results being issued on Monday. My first attempt to do this presentation took about 12 minutes. So what I want to say is cut down considerably. Let's begin with the Stockopedia report. From everything you see, it's a company which has exploded upwards as a result of COVID, and it has become extremely profitable, paid off all its debt, and is now sitting on a cash pile of 91 million. Its current price of 339 can only be described as a beaten up price when it was its highest price was 1276. Investors are not really liking it at the moment, but I think they should consider filling their boots. And I want to say why. It's got a PE of 4.5 now. The quality metrics are brilliant. It's got a return on capital of 77.3%, return on equity of 97%, an operating margin of 60%. An F score of 7 is good as well. Sales growth is phenomenal at 902%. I look at all of the financial summary data, and it's all looking very, very good. There's no talk of dividends at the moment, which some people are critical of, and I think I'm a little bit critical, but let's wait and see what they do with the money. If you look at the accounts section, there's been a massive uplift from December the 31st figures of 14.6 million to June the 30th, 2020 of 58.8 million, and yesterday's figure was 150.7 million. That's 3 times increase since the June 2020 figures. And it passes one screen, namely the Greenblatt's magic formula screen. Okay, that's a quick dash through Stockopedia, but I think everybody's wondering whether I've missed the elephant in the room, which of course is the Department of Health and Social Care dispute that Novacyt have at the moment. I've looked into it as much as I can, but nobody's really saying what it is. I don't believe that it's an efficacy issue. I think it's something with the contract, which they are prepared to do something about. What they're suggesting is replacing the product in dispute, and the product warranty provision has been made accordingly. The best estimate of the cost of replacing is 19.8 million, and this is in the accounts as a provision, short-term provision. Unpaid invoices total 73 million, and that is also part of this dispute. I'm going to park that for a moment, the dispute, because it's a difficult area. Clearly, this whole thing with the dispute is causing a massive distraction, but I don't think it's anything like Armageddon for the company. So I'm so I'm going to park it. The company is obviously nimble and commercially savvy because they were able to use the technology they already had very quickly to be of use in COVID testing. They have been extremely proactive in developing even more sophisticated tests and have launched a lot of new products to simplify testing in different circumstances. I went through the RNS list from the end of August 2020 to now, and it shows 9 test launches, the acquisition of a company called ITIS, or ITIS, I suppose it is, the inclusion of what they call SNP SIG, is being adopted by the NHS England framework, and that's come since the DHSC dispute. It's a sophisticated first-to-market assay panel in a single kit, which is able to detect the 4 most critical SARS-CoV-2 mutations currently recognized.
I think we're at time, Charles.
Oh, are we? Okay. So I think COVID testing is going to be needed for some time, and also they'll be needing to test between, whether something is flu or COVID. I'd put a target of £12 per share at least.
Thank you. What success have they had with replacing the UK revenues with contracts from other countries?
I can't answer that specifically. It's just that I feel that the way the company has been so nimble and quick in getting their products to market, that and they certainly have just appointed a manager in the US and opened up in the US a separate company, but all part of the group. They're looking at other parts of the world, Europe, Germany in particular. So I think going forward, they will be able to replace. But I'm not even sure that they have totally lost they haven't lost the NHS. They've actually just done that big deal with the bit of kit I mentioned, which has a strange name.
There are £73 million worth of unpaid invoices. Aren't you a little bit concerned about that?
Well, I think it's part of this dispute with the DHSC, and I think they are going. Obviously, I don't know the future, and neither do any of us. But they seem to believe that they're going to win the case, and it could all be down to civil servants not getting it quite right. I'm not sure what the answer will be, but I just think that going forward, my target price, I'm looking at about sort of 18 months for my target price of 1,200, because I do believe that they're going to produce quite a lot of other products. And I think they're a very nimble, agile company that's going to be very successful, given the number of new products they've been able to churn out in a year.
And your target price is based on what? Earnings per share and profitability?
Well, I partly based it on the fact that their Nomad, SP Angel, in February put a target price of over 1,400. And I don't think anything has changed since then, except that there's a bad feeling towards Novacyt, and that's all I think it is. I just think that there are people who think its market is going to disappear if COVID disappears, and I don't think COVID is going to disappear. Obviously, it'll be less of a problem to us, but and I'm actually think that there is an argument that says that people are going to have to be able to distinguish between COVID, ordinary flu, and other respiratory diseases. So, and I believe their assays will be able to do that, because at the moment their assays can distinguish all of the present COVID variants.
Thank you very much indeed, Charles. We've got loads more questions, but that's all we've got time for. Damian, back to you.
Cool, thanks, Charles. I must admit, I always felt Novacyt was one that got away as its shares 10 bagged last year. And I know a number of investors who profited handsomely. So it's interesting to see the investment case presented again, now that all the hype's died down. So thank you.
Yeah, thank you.
No problem. Now, next up is Daniel Jones. He's going to talk about Synthomer. Over to you, Daniel.
Good evening. Thank you for listening to my first ever stock pitch. Synthomer, ticker SYNT, During the pitch, I'm going to focus on three key areas: the company, the investment case, and the target valuation. So the company, Synthomer, supplies polymers in three main markets: performance, covering healthcare, carpet, paper, etc.; functional, coatings, construction, adhesive and textiles; and industrial, PVC, sealants, specialist powder coating. Each division performs equally well with minimal concentration risk. Turnover is 2 billion, market cap is 2.25 billion, with an enterprise value of 2.8 billion, all in sterling. The investment case is built on value with a greater than 9-month time horizon. Three main screening metrics. The first is earnings. Stockopedia shows a PE ratio of 10 on broker forecasts. Recent market update from the company expects an EBITDA in 21 in excess of £450 million sterling. If you take depreciation and fixed asset additions of 60 million, we end up with a net profit of 390 million for 21. With an enterprise value of 2.8 billion, net profit of 390, it gives us a 7 PE ratio, a great margin of safety on earnings. The balance sheet, cash is at 200 million, net debt is at 517 million, net debt is only 1.3 times next year's profits. The net debt is a result of an excellent acquisition of Nova, which gave Synthomer a USA presence. Again, great margin of safety with almost zero risk of funding default. Momentum has been positive over the last 12 months, going from 300p to 525p, a 75% increase with no negative news. My target valuation is £4 billion sterling on an enterprise value, about 3.5 billion on market cap, given a share price target of £8.25, 57% gain from today. There's also a 2 to 3% dividend each year payable. In closing, Buffett looks for $1 of retained earnings to generate $1 of company value as a minimum. For the last 5 years, Synthomer profits have been 432 million, dividends and share buybacks 242 million, giving net reinvestment by the company in itself of 190 million pounds sterling. Over the same time frame, the company's value has grown up 1.35 billion. So for every £1 that Synthomer reinvested in itself, they have created £7 in company value. This is the same 7-to-1 ratio as Coca-Cola had in 1988 when Buffett made his first move. Don't have SynFOMO? Please research Synthomer.
Excellent. Thank you very much, Daniel. Have they found a replacement CEO?
Yes, they have. Interestingly, timing-wise, that was announced this morning. So yeah, they've announced a new CEO. Let's get his name. Michael Willone. He's from the industry, and he was appointed this morning.
And why did the old one leave?
I'm not sure of the reason. I'm a CEO, so maybe he just got tired.
Why is net profit expected to decline next year?
I think on the contrary, net profit is looking to increase next year. As I mentioned in the RNSs, they're predicting a £450 million EBITDA. Depreciation and fixed asset additions are average about 60 million a year. So yeah, I think they're going to. My actually biggest risk or my biggest worry is, has COVID created a bumper 2021 for them that's not repeatable in future years? That's one of my risks alongside the CEO.
Well, you stun the crowds. All we've got is this is an absolutely great pitch. So well done. This is the first time that we've got no questions but just compliments. So congratulations to you. And we will leave it there unless there's anything else you want to use your time for.
No, thank you. Thanks for having me.
Oh, hold on. Price target that you've got for it.
£8.25.
And will they not be impacted by the higher crude prices? Are they able to pass on such costs and maintain margins given the low incumbent gross margins?
Yeah, I think inflation is a concern in all business areas. They're naturally hedged well geographically with manufacturing plants in many locations. And fundamentally, I think they'll pass any increases on to the customers.
And someone's saying that they see a lower forecast number for 2022 of 370 million as the consensus.
Okay, I was referring to 2021, 450 million EBITDA. I'll have a look at the 22 number.
Okay, and you've just got loads of people echoing what a great pitch it was. So Daniel, thank you very much indeed. We hope you'll come back again, and I'll hand back to Damian.
Cool, thank you, Daniel. Yes, that's very good. I must admit, I've never looked at Synthomer before. But one obvious positive is that the shares have derated significantly with a PE ratio around 10, which is right at the bottom of the historical range. And with earnings forecast on an improving trend, there's an obvious disconnect there, isn't there, between expectation and reality? So yeah, I need to take a closer look. And finally, last but not least, we have Jack Brumby, and he's going to finish off with Concurrent Technologies. Away you go, Jack.
Thanks, Damian. So this is Concurrent Technologies, the ticker's CNC. It's a UK small cap with a stock rank of 59, but a quality rank of 99. That's what initially attracted me to this one. It's in the technology sector, listed as semiconductors. It's got a market cap of 67 million, EV of 56 million, so net cash of 11 million, and it's generating annual revenues of just north of 20 million. So this is a world-leading specialist in the design and manufacture of high-end embedded computer boards for critical applications. It's been doing this for a long time. It's been doing it since 1985. It's also been paying dividends for a long time. So this will speak to the kind of quality, long-term quality case here. Most of its product lines are available in either commercial or ruggedized variants. So ruggedized means these computer boards can survive in harsh environments with temperatures ranging from -40 degrees Celsius to 85 degrees Celsius. These aren't your average high street computer boards. It sells them to a diversified customer base of leading integrators. So these are large, high quality international businesses across a variety of sectors, including defense, security, aerospace, telecoms, many more, industrials, medical. So there's a lot of demand for these products. I think there's a couple of characteristics here which suggest to me that if Concurrent can get its ducks in a row, it could go on to be just a good long-term quality hold. It's got those proprietary high-performance products, market-leading, sells to international businesses. It's got this culture of continuous development, and it's had that stretching back for decades now. Great quality, that excellent quality rank. It's a dividend payer. It's prudent. It's got very sensible, safe finances. It habitually operates with a net cash position. There's minimal shareholder dilution over time. So there's a real sense of stewardship here. And you can see some of the board members on the major shareholders list. So there's good alignment. On that note, the major shareholders, there are some very solid institutional names here for such a small cap, including Lion Trust, Premier Miton, and Canaccord. I think you have to focus for a second on this momentum rank of 18. This is why it's a neutral in the stock rank style, but I'd kind of classify this as a contrarian. The momentum rank of 18, current trading is not as bad as that might suggest. In fact, in FY20, the brokers upgraded their forecasts towards the end of the year. Throughout that year, Concurrent was designated as an essential defense supplier throughout the lockdowns, which is testament to the products it supplies. And yeah, it had no government help, no equity dilution, no share placings, and it's got a strong order book going forward. So I'm out of time. I'll wrap it up there. Let's keep it punctual.
Jack, thank you very much. Do you have concerns that chip shortages will knock it back short to medium term and therefore the price will remain subdued?
Yeah, that is a risk. So it was Andrew talking about this global logjam, and Concurrent does face those pressures. I haven't seen many numbers explicitly referencing it just yet, but it is there as a kind of shorter term risk. I'm looking at this as a very long-term hold, so that may play out, and that probably will be a factor, and it will be referenced in upcoming updates, and it is something that people should bear in mind in the short term.
And why do you think there's been so little growth in earnings per share for a growth sector?
Yeah, so this is where I would have ended, is the clear fly in the ointment here is a declining returns on capital figure, and the fact that profits haven't been able to track revenue growth, which has been lumpy, but underlying, you can see the trend is quite steadily upwards. The thing is, when you dig into it, gross margins actually track revenues quite well, but the operating margin has declined. And one thing they're doing now, Concurrent has operations sort of around the world. It's got some operations in the US, but it's also got operations in India. And they were finding that India was it was a drag on profits, essentially. And they've just closed the India office, and they're going to bring a lot of stuff back into the UK, back in-house. And they think this will bring about sort of £500,000 of annualized cost savings, should allow them to redeploy capital a lot more efficiently. But that is one of the key reasons why you see that.
And do you think that's where the growth is going to come from? Or where are you looking for growth to come from?
I think that's definitely going to help. I think that'll be a good little catalyst. I think that there could be further to go in terms of like little wins in terms of the cost base, but where it's really going to come from is just the continuous culture of development. As they say, I think they spent something like £3.8 million in the past year on R&D. They do it all the time. They're going to bring out new product ranges over the next year, and that's just what they do. The cost savings they realize from the India operations will feed back into that for sure.
Thank you. And we've almost out of time, but there's a nice comment here which says, my brotherly formerly worked here. He really rated the management and the entire setup. So he agrees with you. Jack, thank you very much indeed. Damian, back to you.
Cool. Yeah, thanks for that detailed summary, Jack. It's clearly an under-the-radar manufacturer that's being held back somewhat by these component shortages. Still, I like the fact the board has been recently refreshed, which suggests that Concurrent could surprise the upside in time. And I'm afraid that is all we have time for. As ever, it all passed by very quickly. We managed to hit 800 attendees this evening, which is quite impressive, given the twin attractions of a sunny evening and footy on the telly. I really do hope you enjoyed all the presentations. I've certainly learned a great deal about some new companies, and I hope you have too. So please join me in thanking all of the presenters for giving up their time to entertain and inform. Remember also, if you want to go back over any of the pictures, the video recording will be out by the weekend, which is always worth a watch. And on that front, I would like to thank Tamsin and Tim from PIWORLD for both hosting the event and putting out the recording, and also Stan for Stockopedia for helping organise things. As ever, we can always get better, and we would be grateful if you can give us feedback on tonight's event. This will help us next time, and I'm pleased to say we do have a date for the next event. It will be on Wednesday, September the 8th at the same time. We are now taking a well-earned summer break, and if the last few weeks are anything to go by, I think the market has also put its feet up because it seems very quiet on the trading floor. So please put that date in your diary and think about whether you'd like to present the pros and cons of a stock. It might seem like a daunting prospect, but everyone of the presenters was in the same position once. And remember, many of the presenters tonight were new for the very first time on the StockSlam. So well done to them. Finally, I would like to thank you all for logging on tonight and joining the conversation on Discord. I mean, there wouldn't be an event without you. And if you want to continue the conversation on Discord or Twitter, that'd be great. Have a fantastic evening. Thank you.